Welcome everyone to today's Title Topics webinar. These are ALTA's free presentations we offer every month on issues important to title professionals. I am Jeremy Yowie, ALTA's Vice President of Communications, and today we've got a great program lined up that will delve into 1031 exchanges and the various closing issues that are involved in handling these transactions. We've had a lot of focus on TRID and third-party oversight, and we thought this would be a great time to change up the subject matter and discuss ways to generate new business. Before starting, just needed to touch on a few housekeeping items. A copy of today's presentation can be downloaded from the handout section of the GoToWebinar window on your computer screen. If you're only listening by audio, you can send me an email at jyowie@alta.org. That's JYOHE@alta.org, and I'll send you a copy of the presentation at the conclusion of today's webinar. All participant lines are muted. You can submit a question through the question box, and we'll hold some time at the end of the webinar. As an added benefit, today's presentation is being recorded. After it's processed, the recording will be available on ALTA's website at alta.org/title topics. That's alta.org/title topics. I need to thank Fidelity for sponsoring our Title Topics webinars this year. Their support allows us to provide these educational opportunities free of charge. And with that out of the way, I'll briefly introduce today's speaker so he can focus more on the content. Joining us today, we have Scott Saunders. He is Executive Vice President at Asset Preservation, and Scott has facilitated more than 160,000 exchanges during his nearly 30 years experience in the industry. Scott, thanks for being here with us today, and with the introductions out of the way and housekeeping, I'll turn it over to you.
Great. Jeremy, thank you very much, and welcome everybody. Real excited to give this talk on 1031 exchanges and closing issues for ALTA. As Jeremy mentioned, I'm a Senior Vice President with Asset Preservation. We're a subsidiary of Stewart Title, and so you can see my background on the screen. Here's what we're going to cover. I'm not going to go through this line by line. We are going to cover a lot of material in this short hour. So we're going to cover things that are relevant, related to exchanges, what's going on in the marketplace today. I am watching the questions, and I will try to answer those at the end. Shanna, you can't get a copy of the PowerPoint presentation, and Laura, hopefully, I'm speaking loudly enough on your end. So anyway, that's an overview of what we're going to cover today. Let me go through fairly quickly at the beginning some common 1031 exchange terminology, just to make sure that we're all talking about the same terms. There's some unique buzzwords associated with 1031 exchanges. So let me give you some simple definitions to make sure you understand some of these things. Boot. Boot is simply defined as non-like-kind property. And there really are typically two types of boot. The first is what's called cash boot. Those are cash proceeds that the investor receives, and that's what cash boot is. They take money out of the exchange either at the closing of the sale property or at the end of the exchange. The other type of boot is called mortgage boot, and sometimes you'll hear that referred to as debt relief. And simply put, this is when there's a reduction in the mortgage liabilities that the taxpayer doesn't offset by adding new cash. So simply, they have a $100,000 mortgage on the sale property. They only have $80,000 of mortgage on the replacement property. Then they've got $20,000 of mortgage boot. So that's the issue there. The next term, constructive receipt. And this one's kind of important. Constructive receipt means the taxpayer may not actually have the proceeds in their pocket, but they're legally entitled to them in some manner, such as having them held in an escrow account or a trust account on their behalf. And where this typically comes up is maybe somebody closes at the very end of the day on a Friday, and they close the transaction. The proceeds are left in your escrow or trust account over the weekend. Even though that person hasn't put the money into their account, hasn't cashed the check or deposited, they are legally entitled to those proceeds, and therefore they have constructive receipt. What that means practically is there's no ability to do a 1031 exchange. It's now a fully taxable transaction. So that's what constructive receipt is. Direct deeding is what it sounds like. It's the direct transfer of title from your client, the seller, to the buyer. And this happens in most delayed exchanges when the qualified intermediary has been assigned in. So we use direct deeding. The exchanger is the investor. It's the person who's selling the property. I'm going to call them a taxpayer, but it's the investor, exchanger, taxpayer. The exchange agreement is an agreement between the qualified intermediary and your client, the taxpayer, regarding the exchange. And it just talks about how those proceeds are going to be held, restrictions on the proceeds, and then also what is the qualified intermediary's obligation in terms of giving the proceeds back or property, preferably, in a valid exchange within that 180-day period. The exchange period is the maximum amount of time that a taxpayer has to do an exchange. So they have up to 180 calendar days, but you'll see a little bit later in the presentation, it can be less than 180 days, and we'll cover that. Identification period is the time that someone can identify a property. They have 45 calendar days from the sale of the relinquished property to identify, and that ends at midnight of the 45th day. Mortgage boot we've already covered. The next term, a qualified intermediary, that's what the IRS calls a company like ours, like Asset Preservation. We're a qualified intermediary. We hold the proceeds, safeguard those, we prepare the paperwork, and we do the function of a qualified intermediary. You also hear us referred to as an accommodator, a facilitator, an intermediary, a QI. So those are all synonymous terms. And finally, to wrap up, the relinquished property is the property that is sold in the exchange. But depending on where you're located in the country, you might hear that referred to as the sale property, the phase one property, the exchange property, or the down leg property. Again, those are all synonymous terms. And then the property being purchased is called the replacement property, and that can be referred to as the phase two property, the target property, or the up leg property. So anyway, hopefully we're all on the same page with some terms there. Some of you may remember the storm a number of years back, or the movie of a number of years back called The Perfect Storm. This is when there were two storms that collided and created this huge superstorm. Well, how does that relate to 1031 exchanges? We really have two events that have created the perfect storm for a huge surge in 1031 exchange activity. First off, we have much, much higher capital gain taxes. In fact, capital gain taxes percentage-wise have gone up 58%. They changed that back in 2013. So right off the bat, there's a huge tax increase if people don't do an exchange and they go through a taxable sale. They're facing much higher taxes. The other aspect of this is we really have a very strong market for investment properties. The commercial market, and we'll look at this in a moment, is very, very strong. Residential market in many areas is very strong. Here in Denver, Colorado, where I'm located, residential properties are now 20% above the previous market peak. And I know lots of areas around the country are seeing very strong residential price increases because there hasn't been a lot of development. Thank you for the feedback there, Wendy, on the volume. So the bottom line is we've got investors with significant appreciation, significant gain in rising rents, and they're looking for ways to reduce their tax liability. So let's look at the backdrop of taxation, unpack it in a little detail. Investors really face four different aspects when they sell a property, potential taxes. First, they're taxed on the depreciation recapture at 25%. And the reason why this is so important is your clients may not realize that they've had a property for 15 years that maybe it hasn't gone up a lot in value, but for all of those 15 years they've been getting the benefit on their taxes of the depreciation. If they don't do a 1031 exchange and they do a taxable sale, they now have to recapture that and pay a tax rate of 25%. In addition, you've got the remaining economic gain, you've got federal capital gain taxes that can be at either 20% or 15%, depending upon the taxpayer's income. We have a new tax, and this came about with the healthcare reform called IRC Section 1411, and this is the net investment income tax, and it's an additional 3.8% tax on capital gain. And then finally, depending on where you're based or where your clients are based, they can face very significant capital gain taxes at the state level. So if you look at this, their taxes could be 0 in some states, or they can go as high as 13.3%. That happens to be in California. So you've got to factor all four of these taxes together to really look at the total tax hit. And what you find out is a lot of your customers, if they sell and don't do a 1031 exchange, they could be facing a massive tax liability. So it's really important that they speak to their tax and legal advisors before closing with your office. to find out what is their tax liability going to be at the end of the day. And they might be very surprised what they're paying in taxes and open to the idea of doing a 1031 exchange. Now, when we look at capital gain taxes, we've got this new 20% tax rate. So this has been added for taxpayers if you're single, over $400,000 in taxable income, and married, finally jointly, over $450,000. So one thing I want to point out there is you've got a marriage tax penalty, don't you? If this was really fair for singles and married couples, it would have been $400,000 and $800,000. But married investors are facing this much earlier. Now, the old rate of 15% remains for people in lower tax brackets. Now, on the net investment income tax, this applies to what's called net investment income. Sometimes that's referred to as unearned income. And you'll see on the very last bullet point, this includes income from a number of sources, but it includes capital gains. Now, this kicks in for single filers at $200,000 threshold, and for married couples filing jointly at $250,000. So again, there's a marriage tax penalty. So that's kind of the backdrop from a tax standpoint. Let's look at the real estate markets. And when I talk about real estate markets, we really have two markets, in my opinion. You've got the commercial market and the residential market. So on this slide, you'll see the commercial market is very, very strong. Right now, commercial real estate prices are about 24% above the previous market peak. And when you look at this, you're now seeing not only strong demand in a lot of core markets and grade A markets, but you're seeing that spill over into secondary markets, a lot of international demand. So commercial real estate is very, very healthy. The next slide just gives you a visual. This is a recent table that came out from Green Street Advisors. Somebody that bought property at the very low of the marketplace has seen their property more than double in value. So that gives you a representation of what's going on the commercial side. Residential, you know, if you look at it, we had a huge decrease. And I won't beat a dead horse. All of us in the industry saw, you know, what that did to people that own property. We saw prices go down about 40% nationally. Well, today, prices are getting very close to the former peak in 2007. Right now, year over year, we've seen home prices up about 6.5%. Single-family rents are up about 2.5% year over year. And really, when we look at the residential side, we haven't seen on a national basis a lot of new construction. So we've got constrained inventory, and that's putting a lot of upward pressure on prices. So that leads us to our topic today, the topic of 1031 exchanges. With the increasing tax rates, investors are desperately looking for a way to reduce their tax liability. And they're looking at a 1031 exchange as a way to defer some or all of the taxes that they otherwise would have paid. So let's look at your client's options. If somebody is going to sell a property or has an investment property, they really just have three options available to them. Number one, continue to hold on to that property. And there's nothing wrong with a buy and hold strategy. The only thing I want to suggest is if your client is in a marketplace where maybe there's not a lot of job growth or a lot of appreciation, they might be missing out on a lot of upside potential by staying in that marketplace and not considering exchanging into another area. Number two, sell the property today in 2016 and pay all the taxes, pay the depreciation recapture, federal capital gains, pay the net investment income tax if it's applicable, and pay the state taxes, and then invest outside of real estate. Here's the big challenge with that strategy. The big challenge is once you do that, you're working with after-tax equity. And it's very difficult to get as good of a rate of return, return on investment with after-tax dollars outside of real estate that your clients could get with fully tax-deferred dollars by staying in real estate. So that's very, very difficult to do. And we all know, you know, a rate on a conservative investment, a money market fund at a bank today is not even paying enough to keep up with inflation. Third option, do a 1031 exchange. And I want to propose there, your clients could do a fully deferred exchange, or they could take advantage of partial tax deferral and do a partially deferred exchange. So it's not an all or nothing proposition. And in fact, you know, our company, we work nationally. We see what's kind of going on in the national marketplace. Many investors take advantage of partial tax deferral. They take some cash boot out and pay taxes on the money that they pull out, and they reinvest in one or more replacement properties. So let's look at the actual code. And by the way, 1031 exchanges have been a part of the tax code since 1921. So they've been around a long, long time, and there's a very established body of tax law supporting them. Here's what the code says simply. No gain or loss shall be recognized on the exchange of property held for productive use in a trade or business or for investment if such property is exchanged solely for property of like kind, which is to be held either for productive use in a trade or business or for investment. Some key takeaways on this. Number one, this is called non-recognition treatment. It is not a tax-free exchange. Sometimes you may hear it referred to that way. It's a tax-deferred exchange, and that tax liability follows the investor from one property to the replacement property and over again. So that low basis follows them from one property to the next. The types of properties that can be exchanged, and we'll look at this in a moment, when you're dealing with real property, very broad and very vast. It could be an investment property for investment, business for business, business for investment, investment for business. So the term of like kind, which we'll unpack a little bit in the presentation, is extremely broad, and you'll see some very creative property transactions. People can exchange things like agricultural easements or conservation easements or a perpetual communication easement for a cell tower, just for example. Air rights can be exchanged, what's called a transferable development right. Water rights in certain states. So we'll look at this in a moment. There's some things you can't exchange, and I'm going to cover a couple of them. The first bullet point says stock and trade or other property held primarily for sale. So stock and trade is inventory held in the ordinary course of business for sale to customers. That's excluded from 1031 treatment. So for example, a home builder that puts up a development, a home development, that's part of their inventory, and it's excluded from 1031 deferral. But look at the other aspect of this bullet point, or other property held primarily for sale. In the real estate market, when we look at that, the term that a lot of us are familiar with is the term a fix and flip. That type of property is also excluded. So if the intent of the taxpayer is to immediately turn around and hold a property for sale, not to hold it for long-term investment, meaning for rental income, if it's anything besides bare land, that type of property is also excluded. And in the next slide, we'll look at the criteria that the IRS uses to determine if property is being held for investment purposes or being held for sale. Fourth bullet point down, an interest in a partnership is excluded. So let me be real clear. Any entity can do a 1031 exchange. A partnership at the entity level can do an exchange. An LLC can. A trust, an S Corp, a C Corp, an individual. So at the entity level, if it's held for investment, that qualifies. However, the code was amended in 1986 to exclude the exchange of a partnership interest. And here's the reason why. The partners, or LLC members, own an interest in a partnership. That's a personal property interest. The partnership at the entity level owns a real property interest. So you can't do an exchange on personal property for other real property. And we're going to look at this. This comes up a lot on investment property transactions. Many of your customers hold title in partnerships and LLCs. So we're going to look at some ways to handle this and kind of the pros and cons of different approaches. One thing I want to point out, we get asked this a lot, what about shares in a REIT? A REIT is a real estate investment trust. Same principle. At the entity level, a lot of REITs do 1031 exchanges, sell one asset in an exchange and buy replacement assets. But a share in a REIT is considered personal property and is also excluded. So I just wanted to mention that. Now, in the next slide, you see there's no bright line test that the IRS has to determine whether property is being held for investment purposes or for sale. They're going to look at all of the different factors, but I want to give you some of the criteria right here that the IRS will look at. The purpose for which the property was initially acquired, how it was subsequently held, and certainly how was it being held at the time of sale. The extent to which improvements were made to the property. Obviously, if somebody buys a piece of land and they go ahead and put in the utilities and roads and subdivide, it looks a lot more like they're holding for resale than long-term investment. The frequency, number, and continuity of sales, the extent and nature of the transaction, the ordinary course of business of the taxpayer. If you've got a client of yours that's a dentist and they happen to turn over a couple of properties in 1 year, that's a very different fact pattern than somebody maybe who's a real estate professional, a developer, who makes all of their money turning over real estate properties, buying and selling them. The next two are where a lot of people get tripped up. The extent of advertising, promotion, any active efforts to obtain a buyer for the sale of the property, and certainly the listing of the property with a real estate agent or a real estate broker. Both of those make it look like it's being held for sale not long-term investment. So anyway, I just wanted to point these out. This is something where somebody wants to consult with their tax and legal advisors to get some input. And sometimes it's a little bit of a gray area, and you may have a few factors that are in your client's favor and a few factors that are not in favor of it. By the way, I got a question here on 1099, and I'll go ahead and be answering that a little bit later in the presentation. So great question coming through. Next slide, let's look at this issue of partnerships. Here's the scenario. Let's say a partnership or LLC holds a property, and let's just make it very simple. There are 3 partners. One wants to sell and pay the taxes. The other 2 want to do a 1031 exchange. What do you do? Well, first of all, we've already touched upon it. A partnership interest is excluded from Section 1031 treatment because a partnership interest is not an interest in the capital asset itself. So that poses a problem. And let's look at some ways in an exchange that this can be handled. Really, there are 2 common approaches, and you may have heard this terminology. One is what's referred to as a drop and swap. The swap means 1031 exchange. The other is referred to as a swap and drop. I'll kind of touch upon them in reverse order here. The swap and drop is where the partnership stays intact. Partnership sells a relinquished property, does a 1031 exchange into a replacement property, and then after the exchange is over, they drop out of the partnership, liquidate it, drop out the interest, or distribute an interest to the departing partner. And I mention this one first because it's much rarer. It works sometimes in a closely held partnership, maybe several family members that want to work with one another. It doesn't work very well when you've got a partnership with 60 partners that have all sorts of different interests. It's almost impossible. By far, the drop and swap approach that you see at the top is more common. What happens with the drop and swap? What you do is you've got to get it out of the partnership or LLC entity. So you actually deed out to those 3 partners, and let's just say they each have a 1/3 interest. Now they each own a 1/3 interest in the property. At the closing, the 2 partners that want to do an exchange work with a qualified intermediary, and they go their separate ways via 1031 exchange. The remaining partner receives the cash for their 1/3 interest, and they pay taxes on it. So that's essentially what happens on it, and that could be with 3 partners, it could be with multiple. So that's structurally what happens is the partnership ceases to exist. It's actually deeded out, and it's called an election out of the partnership. Here are some of the issues that you got to keep in mind with this. It's much better for your customers if they hold title for a significant period of time prior to closing after they drop out of the partnership. So the longer the time period, the better. If you've got to drop out of the partnership very close to the 1031 exchange or under the swap and drop right after it, there's an issue that the exchange may not be deemed to qualify. Because remember, in any exchange, the people have to hold the property for investment purposes. That's the key issue. So the more time that passes between these 2 things, the better. So realistically, I will tell you as a qualified intermediary, we see a lot of people that do a drop out of the partnership at the very last minute. That's not the best way to do it if it's at all possible. The more time that passes, the better. A couple more factors to consider. We've got numerous favorable tax court decisions. You'll see Bulker, Mason, and Maloney where the taxpayer prevailed in situations like this. However, for those of you on this ALTA call and webinar in California, the Franchise Tax Board in California is taking a very aggressive position for the last couple of years. They do not feel like they are bound by the federal cases, and they are going after taxpayers that do a drop out of the partnership right before an exchange for the state taxes. So keep that in mind. The other piece to keep in mind, now when somebody does this drop or swap and drop, they have to report it on the IRS Form 1065, the partnership tax return, that they've done this. So you have to overtly, give that information to the IRS. So it makes it much easier to detect these types of transactions. By the way, there are 3 areas, and I have a slide for this, but there's 3 areas right now where we're seeing a lot of audits. Number 1 would be the issue I just covered, dropping out of a partnership right before an exchange or right afterwards. Number 2 is the next slide you're seeing, related party transactions. Number 3 would be compliance with the identification rules and the time requirements, the 45 and 180-day time requirements. Those are the 3 areas right now where we're seeing a lot of audits. Related party rule. Who is a related party? It's any entity that is related to the taxpayer. So it can be a lineal descendant, a father, mother, brother, sister. Keep in mind, aunts and uncles are not related. Step-parents are not related. So it's a lineal descendant. It's also any entity that the taxpayer has more than a 50% ownership interest in. So if I'm Scott Saunders, an individual, and yet I own 60% of the stock of Saunders Corporation, it's related to me. And to give you a little background as quickly as I can, the whole issue here deals with what's called basis shifting. The IRS is concerned with related parties taking a low basis property and internally exchanging it and then selling off the high basis property to get around paying capital gain taxes. So you have 4 different scenarios today. Number 1, in a simultaneous exchange, a swap of properties, that can be accomplished with a related party. However, both parties must hold it for a minimum of 2 years. So if I swap with my dad, I must hold the new property for at least 2 years, and so must my dad. Delayed exchange selling to a related party is not an issue. So that's not an issue doing that. It's scenario number 3 that a lot of people have questions on. They want to do a delayed exchange and buy from a related party. So I want to buy mom's property as my replacement property. That is not permitted. You cannot do an exchange and buy from a related party, whether it's a family member or whether it's related because of the ownership interest, unless you fall into scenario number 4. You can purchase from a related party if the related party is also doing a 1031 exchange. So instead of them receiving your cash proceeds from the 1031 exchange, they go ahead and do a like-kind exchange for a replacement property C. So that's the one situation where it's permitted to do a related party type transaction. One of the concepts you hear a lot with exchanges is that the entity selling the relinquished property should be the same as the entity buying the replacement property. So you see some examples on the screen. Wife relinquishes, the wife should acquire. Smith LLC relinquishes, Smith LLC acquires, etc. So the vesting is a good guideline, but keep in mind, it's a little more specific than that. The key issue is the same tax owner that sells the relinquished property should be the same tax owner that buys the replacement property. And the reality is you need to look at federal tax ownership, state law ownership, and vesting issues. So you can have a taxpayer that sells as an individual, and if they buy in a single member LLC that is considered a disregarded entity for federal tax purposes, that's the same tax owner. So the vesting is different, but the tax owner is consistent. So there are a lot of different ways to approach that, but just keep in mind in an exchange, it's a little bit more detailed than having vesting identical. It really comes down to having the same tax owners that sell the relinquished as being the same tax owner that purchases the replacement property. I mentioned a little while back, like-kind property when we're dealing with real property is very, very broad. So you're going to see some different images coming on the screen that represent like-kind real property that maybe you haven't thought of as like-kind real property. Certainly, investors can go from one commercial property, let's say an office building, into another office building or another apartment complex. But you're going to see all sorts of images on there that maybe you hadn't thought of as real property. A ranch can be exchanged for commercial property. Farms can be exchanged. I mentioned water rights can be exchanged. A lot of different things with real property abroad. Certain oil and gas programs can be considered like-kind real property. You can go from raw land into improved real property. So lots of different variations are available, but you can see a nice visual representation on the screen that real property is very broad. When we look at what's excluded, there really are just 2 types of property that don't qualify. Number 1, the taxpayer's principal residence, the house that they live in, cannot be exchanged for an investment property, nor can you exchange for an investment property into a property you're going to move into right away. Number 2, property is held for sale or dealer property is excluded. Other than that, when you're dealing with real property, it's very, very broad, and anything held for investment that's real property can be exchanged for any other real property held for investment. By the way, I just want to point out on personal property exchanges, there's a whole universe of those. You can exchange collectible artwork for other collectible artwork. Lots of aircraft go through exchanges, exchange for other aircraft. All sorts of things can be exchanged as personal property. Those rules are much more narrow and specific. And for those of you that deal with customers maybe selling a hotel, let's say, You might have a real property component and a personal property component. So keep in mind there might be two exchanges, real property for other like-kind real property, and then personal property for other like-class personal property. Some other areas I want to talk about. A vacation home held for investment can qualify for an exchange. So if you look at this, we got a safe harbor in 2008 called 2008-16. And to qualify, you really have three simple things to do. Number one, 2-year holding period, so it's got to be 24 months. During that 2-year holding period, the property must be rented at least 14 days, and you can rent to family members as long as they rent at fair market value. And the last one is kind of the kicker. The taxpayer's personal use of the property can't exceed 14 days or 10% of the time it's rented. But there's a lot of opportunities to take advantage of exchanges into qualifying vacation property. Another big trend that you may have heard of, or what are referred to as fractional ownership. Years ago, these were referred to as TICs. Most of these today are done as DSTs, what's called a Delaware Statutory Trust. What this allows your clients to do is exchange into a slice of a much larger commercial property. So instead of being in very active management of real estate, they go into what's considered a passive investment. They go into a large institutional grade property with a lot of other co-owners, and there's generally something called a sponsor that manages the property. So these are very, very popular for obvious reasons. It gives people nearing the end of their investment time horizon, or those who want to be more passive, an ability to not pay taxes and go into a passive investment. These are available only to accredited investors. So it's got to be somebody that meets certain net worth requirements, and it's a whole separate entity. By the way, these are sold through licensed security financial advisors. They don't go through a real estate agent or broker. They're treated as kind of a hybrid. The SEC considers them a security, and the IRS says that they qualify for 1031 exchange tax deferrals. So I just wanted to mention to you, those are some creative opportunities that are out there. A question we get asked a lot, and one that you may have heard of from your customers, is this: how long do I have to hold a property before it's considered held for investment purposes? What's the time period? And I'm going to give you the answer to this question. Here's the answer. There is absolutely no time period anywhere in the Internal Revenue Code. There's no mandatory time period. There's not a 2-year holding period. There's not a year and a day. There's not a 1-year holding period. The key thing is that the intent of the real estate investor is to hold for investment purposes. So the IRS is going to look at all of the objective factors they can to determine what is that investor's intent. So certainly the time period is important, but it's just one of a whole list of factors the IRS will look at. In a perfect world, your customers, if they want a conservative exchange, should have a lot of facts and circumstances that support their intent to hold for investment. So keep that in mind. There is no holding period at all, and I'm just going to quickly go through two cases. The first one, Goolsby versus Commissioner, didn't qualify for tax deferral. The second, Reesink versus Commissioner from 2012, they did, and they had only an 8-month holding period. So let me go through quickly the facts and circumstances. In Goolsby, they did an exchange into a home, and they did not get 1031 tax deferral. They moved into it after 2 months. They happened to sell their primary residence at the same time. They bought a replacement property in an area where the HOA prohibited rentals. So right off the bat, that doesn't meet the smell test. They didn't attempt to rent the property. They actually made improvements to it for personal use. And finally, they actually told their qualified intermediary they intended to move into it right away. Your conversation with a qualified intermediary is not a privileged conversation. It's not. It's not concerned with. It's not a protected conversation. So if the IRS subpoenas the qualified intermediary, and your client said they intend to move into it, then they're going to go ahead and have to disclose that. So this didn't qualify. Let's look at Reesink. In Reesink, they did get a valid exchange even though they only rented it for 8 months. Or sorry, they rented it. They held it for 8 months. So this is one where we had very favorable facts and circumstances on there. The taxpayer went into a property up in Northern California. They tried to rent it. They put a sign out, flyers throughout town. They had no personal use. And then 6 months later, one of the taxpayers lost their job. They couldn't afford their mortgage on their primary residence, so they sold it, and they moved into the property after 8 months. And the IRS was able to determine that they had enough facts and circumstances to show that it was held for investment purposes. So again, this is important that your clients speak with their tax and legal advisors to get some input on this. Let's switch gears and look at what are the requirements for full tax deferral. For full tax deferral, somebody needs to meet two requirements. Number one, reinvest all of the net exchange proceeds. Number two, acquire property with the same or greater debt. So in this example, somebody sells for $900,000, their debt's $300,000, the closing costs are $60,000, leaving their net equity of $540,000. Now let's look at what they're going to go ahead and buy. They buy a replacement property for $1.2 million. Their debt goes up from $300,000 to $660,000, so there's no mortgage boot. They reinvest all of their net equity. So in this example, we have somebody that has a fully deferred exchange. There is no boot whatsoever. Now on the next screen, you'll go ahead and you'll see same sales scenario, but they buy for $700,000. So right away, if somebody goes down in value significantly, you know there's probably going to be a tax consequence. So in this example, the debt goes from $300,000. Their new mortgage is $260,000, so they have $40,000 of mortgage boot. Net equity is $540,000. They only put $440,000 in. There's $100,000 of cash boot. Add those two together, and you'll see in this example, there's $140,000 of boot. One quick comment. Boot is potentially taxable. It's taxable to the extent that your client has a capital gain tax consequence. They may have some carry forward losses that can be used to offset the boot. So I just call it boot. And again, they have to consult with their tax advisor to determine is it taxable for them. One last one I want to show you. This is on the screen an example of somebody selling the same scenario. They reinvest all their cash, but they still go down a mortgage by $40,000. That results in $40,000 of mortgage boot. Just keep in mind that this is a scenario that can surprise some taxpayers. They think that all they have to do is go ahead and do an exchange on the cash, and they forget about the fact that they need the same or a greater amount of debt. Keep in mind there's one exception to that. They can go ahead and go down in debt in their mortgage if they offset that reduction in mortgage by adding new out-of-pocket cash. So that's the one exception to that. On the next screen, you'll see that there are a lot of different ways to do an exchange. You can do a swap. Those are very rare. What's called a three-party format, which is very rare. You can do a delayed exchange with a qualified intermediary, QI. And then there are three things called parking arrangements. Reverse exchange, improvement exchange, and a reverse improvement exchange. This is where an entity owned by the intermediary is parked on title. And those are very creative. We got guidance for this structure back in 2000 with what's known as RevProc 2000-37 and put a 180-day period on there. So a lot of different ways to do it. Let me walk through the delayed exchange because this is the most common. Your client is at the top, the taxpayer. They get the property under contract. Now prior to closing, has to happen prior to closing, they contact a qualified intermediary. We are assigned into their purchase and sale agreement. So we step into the shoes as the seller. We sell the property to the buyer, and we instruct you as the closing officer to directly deed it. The money then comes to us. So that's the first part of an exchange. Now on the purchase side, they look for a property they want to buy. They get it under contract. They assign that contract to the intermediary, and then we go ahead, we take the money we're holding, we buy the replacement property and have it directly deeded to them. So if you look at this, nowhere do they touch the money in any way. The qualified intermediary sells the relinquished property. The qualified intermediary buys the replacement property. Now you see some timelines at the bottom. These start when the property closes. So you've got two key time periods. You have 45 calendar days from the closing till midnight of the 45th day. This is called the identification period, plus another 135 days, so a total of 180 days is what's called the exchange period. So these are common issues, and right now in the marketplace, it's a seller's market. Where people are having challenges is finding good replacement properties that are priced well and perform well within that 45-day period. That's the challenge right now. Keep in mind the 180-day period is a maximum of 180 days. It could be less. It's 180 days or the date the taxpayer must file its tax return for the year of the relinquished property, whichever is earlier. So if you have any clients closing after the middle of October and they file their tax return on April 15th, what they need to do is file an extension, next complete their exchange in 180 days, and then file their tax return. The identification rules. Taxpayer has three ways to do this. First one is called the three-property rule. They can identify three properties of any fair market value. So they're limited to three, but the price is unlimited. Under the next rule, and by the way, these are all separate rules. They just choose any one of these three rules, called the 200% rule. They can identify as many properties as they want, but the fair market value of what they identify can't exceed 200% of what they sold. So if they sell for $400,000, they can identify as many as they want, but not over $800,000 in value. Finally, the very last one is what's called the 95% rule. They can identify more than 3 properties and more than 200% of what was sold, of the value of what was sold. But they must then close on 95% of the value of all properties. So essentially, if you sell and you identify 10 properties, let's say they're all worth $100,000, and you buy 9, that's only 90%, and you would not have a valid exchange. So it's called the 95% rule, but practically speaking, they really need to buy everything if they opt for that. How do you identify some highlights? First of all, it's got to be in writing, and it must unambiguously describe the property, and that's going to be a street address or a legal description for unambiguous, and it's generally sent to the intermediary by the 45th day. So those are some highlights. I did want to mention some things not to do, and the one I want to touch upon is the last one. Dobrik versus Commissioner is a situation where somebody backdated their identification. They were hit for their capital gain taxes, in this case $2.2 million, plus a fraud penalty of 75%. They had to pay another $1.6 million in a fraud penalty. So the bottom line is exchanges provide your clients a lot of flexibility, but you've got to comply with the rules and regulations. And if you have clients that try to get around that or skirt that, pure and simple, it's tax fraud. And if the IRS discovers it, there's going to be a significant penalty in addition to paying the capital gain taxes. This on the screen here, this is an example of a strategy of taxpayers selling 3 smaller properties, consolidating all the money into one larger sale. And what I want to point out here, when somebody sells multiple properties and they go into one larger property, the key thing to keep in mind is it's really just one exchange. Whenever the first property closes, starts the 180 days for the remainder of the exchange. So keep that in mind. The one that most people do in a multiple property exchange is what you see up here. This is somebody selling one relinquished property and then splitting that equity into multiple purchases. And I would say probably 60 to 70% of our customers will exchange into 2 or more replacement properties. So they're taking that equity and they're leveraging it into either a larger property or several more properties. I mentioned earlier something called parking arrangements. A reverse exchange, and I don't have time in a shorter presentation to go into all the details, but these are very popular. A reverse exchange allows a taxpayer to buy the new property and close on it before they close on the sale of the relinquished property. So they have, again, 180 days to stay under the revenue procedure to do that. But in today's market, we see a lot more reverse exchanges because somebody might find an off-market transaction or maybe a very motivated seller, but they need to buy it right away. And a reverse exchange is a perfect solution. The improvement exchange, you can build a brand new property, which is great for owner users. Maybe somebody has wants a commercial property or wants to develop to their exact specifications. Or you can buy an existing property and make refurbishments to it. So maybe it's a C-class apartment complex that other people have overlooked. During the 180 days, you can make improvements to it, add value, now bump up the rents as you release to new tenants, and now you've got an asset that was a good purchase with a value add component. And then finally, a reverse improvement is where you can go ahead and buy the property that you want first and begin construction on it, make improvements to it before you close on the sale. By the way, just a side note, I'm seeing a lot of questions. I will get to all of those at the end. I'll do it in kind of rapid fire fashion. But Cody, question you had, can an attorney who is an in-law related to the taxpayer, can they be a QI? And the answer is no. That's called a disqualified person. So an intermediary has to be a fourth-party principal that's not related to the taxpayer in any way, doesn't have an agency relationship. They cannot have provided tax or legal advice within a 2-year period. Let's kind of switch gears to issues that are really important to closers, closing officers, escrow officers. First of all, can an exchange be set up at the closing table? And the short answer is absolutely. As long as the burdens and benefits of ownership are not transferred from the seller to the buyer, you can be set up at the last minute. We do a lot of exchanges at the very last minute. What needs to be done? You need to go ahead and stop the closing, call a qualified intermediary right away and explain that you've got a rush transaction. Then the qualified intermediary will prepare the documents and forward them to you right away. Have the exchanger, the seller, and also the buyer sign the documents. What are the documents that a qualified intermediary will prepare, or what's needed? They're going to need your customer's contact information, email, phone, address, your contact information, including your file number, the property that's being sold's address, the vesting for the buyer, and then also a copy of the purchase and sale agreement, and then the title commitment. So that's what you need to forward on over to the qualified intermediary. The intermediary is going to prepare a number of things. Prepare a 1031 exchange agreement, an assignment agreement, which assigns the rights to sell the property on over to the intermediary. And then there's a notification. So that's called a notice of assignment for the buyer. They're being notified that the contract's been assigned. And this is very important. These two documents are needed in order to have direct deeding. So you have to have the contract, the rights of the contract assigned to the qualified intermediary, and written notification to the buyer. There are going to be some exchange account forms that are set up that are needed to go in place in regards to the exchange proceeds. And then finally, you should be receiving as a closer very detailed instructions on what changes need to be made in the settlement statement to reflect a 1031 exchange versus a typical sale. So let's kind of walk through those items. This will answer some of the questions that I've seen. What do you need to do differently? Well, first off, the qualified intermediary is actually the seller on your settlement statement. So you see the example, for example, let's say Asset Preservation Inc. as qualified intermediary for John and Joan Smith. So the intermediary, qualified intermediary, is actually the seller. All the other closing documents, so if you're out west, things like escrow instructions, should show the qualified intermediary as the seller. Then your client, the seller, is going to go ahead and is going to read and approve all the documents prior to having the qualified intermediary sign off. You as the closing officer are going to prepare a Form 1099-S in the name of the seller. And what you want to do is check box number 4 on there, indicating that other property will be received as part of the consideration. In almost all delayed exchanges, direct deeding is used. So the title will go directly from your client, the seller, directly to the buyer. If it's a reverse or improvement exchange, there's an entity called an EAT, an exchange accommodation title holder involved, and so you might have sequential deeding, and the intermediary will give you instructions. And then finally, the proceeds are going to be sent by wire transfer on over to the qualified intermediary. In the event your client wants some boot, they can take boot out of the exchange a couple of ways. First off, they can take it right out of the sale closing. So they say, please give me $50,000 proceeds, have the remainder go into the exchange account. And you can do it that way. They can also receive the cash at the very end of the exchange after they've bought all the replacement property that they're entitled to under the exchange agreement. But if your client knows that they want some cash boot, it might be advantageous to get that out right at the very beginning of the exchange. So that's how that can be handled. Now let me switch into a topic that a couple of things. Earnest money deposits. We get a lot of questions on this in an exchange. If there's been an earnest money deposit for the sale, as long as the closing has not happened, right, as long as it hasn't closed, the seller can go ahead and get that money back on over to you, include it in the transaction. If they keep the earnest money, then obviously that's taxable boot. But there's no problem with them receiving earnest money and getting it back to you prior to closing and including the 1031 exchange. On the purchase side, we get a lot of questions. How's that handled from an exchange perspective? One way is you can have the qualified intermediary assigned in. They now become a party to the transaction. They're now the buyer of the replacement property. And then they can go ahead and advance exchange proceeds to your escrow or trust account. Alternatively, your client, the taxpayer, can go ahead and advance those earnest money funds. Then when we go ahead and you prepare the closing statement, you can actually have the qualified intermediary replace the earnest money deposit with exchange proceeds. So in that case, you would go ahead and you would have a line item on the settlement statement of the amount of the earnest money shown as refund of earnest money to taxpayer or to exchanger, showing that money replacing it. An issue that comes up a whole bunch with exchanges that a lot of people aren't aware of, there's a whole concept here of something known as an exchange expense. So really what you want to look at is what's considered a pure transaction cost, a cost of buying and selling real estate versus an ownership or operating cost. So you'll see that an exchange expense includes a whole bunch of items, transfer taxes, the real estate agent's commissions, closing or escrow fees, attorney fees, recording fees, the qualified intermediary fee, title insurance fees, transfer taxes, and notary fees. All of these are considered exchange expenses, and so paying these with exchange proceeds does not create boot. But there are a whole bunch of issues that we all know, especially on commercial transactions, that involve other costs. So when you look at some other non-exchange expenses and other ownership costs, you see a whole list here. Mortgage points, credit reports, loan application fees and loan fees, reoccurring property taxes, utility charges, HOA fees, hazard insurance, and things like credits for lease deposits, prepaid rents, and security deposits. All of these are considered non-exchange expenses. They're actually ownership costs. And these need to be treated very carefully in exchange. Some ways to kind of handle this, and particularly with things like security deposits and prorated rents, there could be an issue if these are not treated right on the settlement statement. So one way to do this is to offset these non-exchange expenses by having the seller pay these directly to the buyer from an operating account, so they're not reflected on the settlement statement. That's one way to go ahead and do it. Another way is your client can go ahead and deposit an amount equal to these non-exchange expenses, and then you've got an offsetting credit on the settlement statement for those things. So these are some things that are very important to review with your client, with the qualified intermediary, and with your client's tax and legal advisors, hopefully so it's not done at the last minute, because I know as a qualified intermediary, we try to provide some input and it flags some issues that could come up, and if you've got a crunch time at closing, that could be a challenge. What I want to switch gears on are some recent developments, and one of the big things to take in mind right now is that over the last few years, we've had an issue where 1031 exchanges have really kind of come to the forefront as being potential candidates to be eliminated in the interest of tax reform. And the long and short of it is this. There's a group in Washington called the Joint Committee on Taxation, and they look at the cost of various tax code provisions. Well, for many years, the cost, what's called the tax expenditure of a 1031 exchange, was really kind of constant, somewhere in that $10 to $15 billion range. All of a sudden, in 2014, the JCT scored 1031 exchanges at different costs and said, wait a minute, over a 10-year period, this is costing the government $41 billion. Then they revised that estimate to $46 billion, and finally, later in that year, they revised it to $98.6 billion. Well, once you get close to $100 billion of lost tax revenue, people in Congress start to go, maybe this is something we could look at to modify or eliminate to go ahead and do something. And what a lot of want to happen in Congress is they want to drive down corporate tax rate from today's 35% down to 25%. Jeremy, I got your notes there. I'll get it. So they're using 1031 exchanges as a potential way to offset that, to pay for tax reform. Well, we had back at the House side, we had a proposal under what was known by the Dave Camp bill to completely eliminate 1031 exchanges. So right now in the House, Kevin Brady, who's chair of the House Ways and Means, is looking to pass a tax reform bill, and he's using many aspects of Dave Camp's bill to do that. On the Senate side, Orrin Hatch on the Senate Finance Committee is also working on a tax reform bill. And then finally, you'll see President Obama has proposed limited exchanges to $1 million. He's done that for the last 3 years, and then eliminated exchanges of collectibles, artwork, and personal property. So you really have all three branches of government either looking at potentially eliminating exchanges to pay for tax reform or significantly reducing. There was a study done last year by Ernst & Young and showed that if exchanges were eliminated, the cost to the economy would be somewhere between $60 to $131 billion over 10 years. And the reason is there are a lot of jobs created by exchanges. It allows people to move their investments from one state to the other, and there are a lot of transactions that are stimulated by 1031 activity. So when you look at the Ernst & Young study, they came out and really said, at the end of the day, we'd have longer holding periods, greater reliance on debt financing, and bottom line, capital would not be deployed as efficiently. And then with the NAR, National Association of Realtors, they did a study and showed that 63% of all realtors participated in a 1031 exchange in the last 4 years. And without Section 1031 exchanges, 40% of the realtors said the transaction would not have occurred. and 56% said that the project would have been smaller in scale, and that's because there's less equity, there's less to reinvest. So if you're looking for more information on this, there is an excellent website, 1031taxreform.com, to get the latest developments. And Jeremy, I just wanted to cue this up for a little bit of what ALTA is doing in regards to advocacy.
Yeah, thanks, Scott. I know we're getting close to the top of the hour, so just wanted to highlight a few points. ALTA has been watching tax reform really closely. We've been working with coalition of real estate trade associations to protect 1031s. Just a few specific examples. In January, ALTA worked with U.S. Rep. Steve Stivers from Ohio on an op-ed piece that outlined why repealing like-kind exchanges would reduce jobs, raise rents, and deepen debts. And then last year, ALTA also sent a letter to the Senate Finance Committee when they were forming working groups on tax policy changes that highlighted how 1031s allow investors to reinvest capital in assets that better meet current business needs and foster further economic growth. And going forward, we'll continue to talk with Congress about the importance of certain tax provisions in the real estate market, including 1031 exchanges. And if you need, if you have any questions about ALTA's advocacy on 1031s, please reach out to us. The main contact at ALTA for this is Ben Lincoln, and his email is benjamin@alta.org. Thanks, Scott, for that quick plug about what ALTA's doing. I'll hand it back to you.
Excellent. I've got about 2.5 minutes to wrap up. Your clients will always fill out IRS Form 8824, the like-kind exchange form, whenever they do a 1031 exchange, and then kind of home stretch. The most important thing you want to look at is when you do due diligence on a qualified intermediary are the security of the proceeds. That's the #1 issue in an exchange. So I want to give you some criteria to look at there. Does the qualified intermediary offer its customers the written backing of a large creditworthy entity? What sort of financial protections? Do they have a large entity behind them? What's the financial rating and balance sheet of that entity? And also, where are the funds deposited? What sort of institutions are they invested in? You don't want a QI to be a huge depositor in a small local bank. So those are important questions. On the next slide, here's the #1 thing to look at. Does the QI offer a segregated account? You want your customers to have their funds go into an account that is segregated on their behalf, not a commingled account. So this is the #1 question. Make sure that it's a segregated account where those funds are set apart just for your specific customer. You can set it up with what's called a fully fettered account. It requires the taxpayer signature along with the qualified intermediary signature to open up the account and to move funds at all times. QIs can offer a qualified escrow account, a qualified trust account, and then certainly ask about their fidelity bond coverage as well. Finally, wrapping up on home stretch here. If you've got questions, and I've tried to cover a lot in 59, 60 minutes, a lot of the latest developments with exchanges, my contact information is on the screen. My toll-free number is 888-531-1031. The website, we just released a brand new website a week ago, and we've got information on there. We've got a closer's handbook with sample settlement statements for closing officers, shows you different scenarios. So feel free to take advantage of that. What I want to do, I think, is hand it back to Jeremy, and then I'll be happy to go ahead and go through the questions I was asked. I'll go through them fairly rapid fire. But Jeremy, let me hand it back to you, and then I'll start answering the questions. Does that sound good?
Yeah, or if, in lieu of time, if you just want to tackle some questions, and then I can wrap up. But just as a reminder, we are short of time, but you can submit questions through the Q&A box, or, Scott's contact information is there in the screen and in the PowerPoint. Just a reminder, if you missed parts of today's webinar or think others in your office would benefit from listening, a recording of the presentation will be available hopefully later this week or early next week after it's edited. And again, you'll be able to access this at alta.org/title topics. You can also always just reach out to me with any questions. My email is jyohe@alta.org. Just a quick plug for next month's Title Topics webinar in July. We'll be addressing the Department of Labor's new overtime rules that go into effect in December. We'll be providing an overview of the new requirements, discussing exempt, non-exempt employees, and talk about how this will basically impact title professionals and title companies, settlement companies across the country. So keep an eye out for more information on this webinar. And Scott, if you want to do a little rapid fire Q&A here to go for it.
Excellent. Alma, your question. Simultaneous exchange, if it's a simultaneous exchange, you still need an intermediary unless it's a swap of properties. Chad's question, when an exchange fails for failure to identify replacement property, if they don't identify within the 45 days, they can receive the money back on day 46. If they've identified properties and they're outside day 45, they must either buy all the property that they're entitled to or wait until day 181, the expiration of the exchange period. Leslie, your question regarding title. So a lot of people want to change title right before an exchange, and many tax and legal advisors advise not to do that. And you generally don't want to change title right before an exchange because the entity selling must hold property for investment. So that's the key issue. Deborah, your question on state taxes and management fees, those are all non-exchange expenses, so you can't use exchange proceeds to go ahead and pay for them. Cody, your question regarding somebody who's an in-law, they could be a closing agent, but the QY, again, has to be a fourth-party principal. And I already mentioned the tax forms are Form 8824. Oh, great question, Tina. Is a qualified intermediary licensed? Great question. We are not regulated at the federal level. So when we're qualified, really that's a term the IRS uses. There are state-level regulations or consumer protection laws in a handful of states. California, Nevada, Oregon, Washington, Colorado, Virginia, and Connecticut. I may have missed one there, but there's state-level regulation and on intermediaries. So with that, if you've got additional questions, please feel free to reach out to me. I want to thank you for your time. You do have a copy of the PowerPoint that was forwarded out by Jeremy, and any questions you've got on title issues and closing issues related to exchanges, feel free to contact me, and I'd be happy to answer them. And Jeremy, I'll turn it back to you. Thank you.
Oh, all right, thanks, Scott. Man, all-star performance, tackling all those questions there at the end. Again, please reach out to Scott any further follow-up you need, or with me. With that will bring us to the conclusion of today's presentation. Scott, thank you for joining us. I hope all the listeners found today's presentation useful, and take care, everyone.